Hi everyone, welcome back to the channel where it's the best place to learn about Canadian finance. Now, we're stepping into September, it's a new month, let's do another monthly update on the real estate market. A lot of things have happened in the past month, so tons of things to cover, anywhere from trends and stats update to a very spicy fight that happened on the internet between the CEO of CMHC and a pretty big realtor in Vancouver. So without further ado, let's jump into the video. Alright, so right away, let's start with the Twitter fight that happened a week ago between the CEO of CMHC, Evan Zidell, and a Vancouver realtor named Owen Bigland. Now, I want to talk about this not just for the entertainment value, but I think there's something to be learned between what was said. So it kind of started on August 23rd when Owen made a bunch of tweets relating to Vancouver real estate. And the first one was saying the negative complainers say we're in a bubble, what if market goes down, always an excuse why they don't invest their money and get it working for them. A 20 plus holding period will remove any downside and guarantee massive return. Crazy how people miss this. And then the next day, he followed up with a third tweet saying that many people miss the leverage factor in real estate. Example, buy a condo for $500K with 10% down. 3 years later, that condo appreciated to $550K. Many look at it as a 10% return when in actuality is a 100% return. Leverage is how true wealth is built. You need to get your money working. So basically what he's saying is when you buy a property with $500K, it goes up 10%, so you earn $50K. You didn't really earn 10%, you earn 100%. Your $50K just made another $50K, so that's a 100% return. That's basically how leverage works. He's just explaining the basic principle of leverage. There's nothing wrong so far theory-wise. However, that kind of triggered Mr. Zidell, and he tweeted at Owen saying, "Sai, because in your made-up world, price only goes up. This kind of investment advice is like selling penny stocks because they're cheap. You do realize leverage works just as powerfully when price goes down, or were you not alive 2008, 2009? So on this note, Evan is pointing out the other side of leverage, which is leverage can magnify your return, but they can also magnify your loss. As we can see, a lot of people went through this in 2008 and 2009. But it doesn't stop there. Owen replied saying, people will also say leverage can work against you when prices goes down. Yes, they can if you're a trader, flipper, not when you're buying a principal resident at 2% and holding it for 15 to 30 years. Your home is not a stock. You need roof over your head. Sure beats renting." So I'm not really sure about the 2%. Either he means 2% mortgage rate or 20% down. So far on that note, I don't fully agree with what Owen said because of two things. One is renting, you still have a roof over your head. And number two is buying always better than renting. It depends on your situation and your habit of investing and spending, but in some cases, not necessary. So just to do a very quick calculation with you guys, here's an example. Let's say someone is buying a $500K home with 20% down, so they have to borrow $400K. Now, let's say the average interest rate over the next 30 years is about 4%, and then we have a 30-year amortization, according to calculators on website. So it's about $2,344. Now, on the other hand, let's say you're renting a one-bedroom in Toronto or Vancouver, you're probably renting for $1,500 right now. Let's say that's your rent, and let's say that's forever. You're gonna have a difference of $844 per month. And let's say you put it into an S&P 500 for the next 30 years, every month at $844. Using the last 30 years rate, your portfolio will be 1.4, almost 1.5 mil pre-tax. Whereas looking at other side, your $500K condo in 30 years, I don't know how much you can sell it for, not sure, because you can't really look at price index because you have to remember it's a 30-year-old condo, which probably have a lot of issues by then and it's very old. And a lot of people probably don't prefer to buy something this old. Plus, there are probably extra maintenance costs going into it. So looking at this scenario, you probably have to sell your condo at 2.5 to 3 times the price, just so we can match what you're doing in the S&P portfolio. Now, this is a super simplistic calculation. I ignore a lot of things. For example, you might be buying, selling houses in between, which give you even more profit. You might be flipping houses, etc. But I just want to make a point saying that it's not necessarily always better to buy versus renting. This is a very personal preference, and it all depends on your own cash flow, your methods of investing, your rate of return you're getting every year, and your risk tolerance, etc. So, of course, Mr. Zidell is not going to be happy with this reply, he replied back saying, more self-serving advice from Owen Bigland. He says rented home isn't a roof over your head. Okay, so just what I said. And he seemed prepared to guarantee if you buy a house, you'll always have a job for life, and employment, e.g. as a result of pandemic, will never force you to sell your house. So again, he's looking at the realistic scenario where buying a house is not always good for you. And then he also further followed up by tweeting, buy a condo for 500K with 5% down, price falls 10%, and you're forced to sell. You've lost your 25K down payment and still owe 25K more to mortgage. Plus the cost Owen Bigland missed. 19K for mortgage insurance, 25K real estate fee, 30K interest, legal cost, land transfer tax. So basically what he's trying to say is when you buy your first home for 500K with 5% down, you basically put down 25K, right? So you borrow 475K. If the price goes down by 10%, your house now went from 500K to 450K. And then let's say you're forced to sell, you would have recouped 450K back, but you owe the bank 475K. Now you still owe the bank 25K, plus you lost the 25K down payment that you put in. And then they have other tweets after that, but I don't think it's worth discussing. There's no more education value in there. It's just more back and forth yelling at each other. So all in all, I think both are right. One person was being idealistic, just talking about math, while the other was being realistic, talking about real scenarios. So I think at the beginning, both were not at fault. They're not even talking about the same thing, actually. But as soon as Owen tweeted back, it made him look like he gave no thoughts before he tweeted or put advice on his own Twitter. But anyway, all in all, thank you so much for such a spicy tweet. It also provided me content to educate my viewers, so thank you for that. Alright, so next, let's talk about some stats that's going on in Canada right now and what does it really mean for us in the real estate space. So number one, let's look at rent. That's something I said over and over again. It's very important for us because rent will dictate how many investors will be incentivized to start selling the unit because rent no longer makes sense. So looking at the newest report from rentals.ca, we can actually see that rent have stabilized for first time in many months. Now, if we look in the report by property types for BC, Alberta, and Ontario, we could see that one bedroom has one of the biggest drops. That's no surprise here because of a couple of things. First of all, one bedroom means the renters are probably young couples or single people. They're usually the most flexible if they really want to move. So one bedroom usually come and go very fast. And also because of working from home situation, a lot of people find that one bedroom is no longer sufficient because there's no longer a place for them to just come in and sleep and go to work the next day. They actually have to set up shop inside the home. So they might be looking at one bedroom plus stand or two bedroom or above. So this makes one bedroom less attractive. And this is also why, as we can see in BC, 3-bedroom rent actually went up. So demand for it is actually higher. Now, if we look at year-to-year rent across cities have dropped, except for Montreal. From reading the report, rentals.ca did state that it could be because they have changed the data set a little bit. That's why the number have been skewed. But from talking to my own clients and understanding, Montreal is offering a lot of tax incentives for filming industry and artists to go over there and set up shop. And that's what made demand in Montreal space a lot higher than before. Another interesting thing is Toronto downtown is one of the places that's been hit the hardest since the pandemic due to work from home. If we look at the map across Toronto downtown, no matter where you're renting, your average rent drop over 10% year to year. So the key we really have to pay attention to is once COVID starts slowing down and phasing out, what's going to happen with the work from home situation? If work from home continues, rent is going to be a lot harder to recover back to the level it was before the pandemic. Lastly, like I said last time, immigration numbers are one of the most important things to sustain the rental market because they're majority renter when they first enter Canada. And as we know, immigration number is down significantly. If this number doesn't pick up fast, then rent will also get impact in the long run. Alright, next let's look at stats on actual property price. So if we look at current sales trend, then obviously the market is extremely hot across Canada. Many cities are selling super fast. the number of days on market is extremely low, especially for Vancouver and Toronto. However, there has been reports saying that inventory has been stacking up even faster and it's on the rise. Many places have entered into 3+ months of inventory. However, 3 months of inventory is still far away from being a buyer's market. Typically, 5 months plus will be a neutral market, and then 8 months plus will be officially at the buyer's market. So we're still many months of inventory away from getting into there. But the trend is saying that it is adding up, which is also interesting because as we can see, the number of days a listing is on the market is quite low. So it's indicating that it's selling quite fast. However, inventory is building up. So let's look at what's happening to the actual inventory. So I went on a lot of third-party websites that pull data from MLS or TREP, and I try to gather the info on different cities. So in Vancouver, there's a good website called myrealtycheck.ca, which pulls all the data and tell you all the most recent price change, whether units are being price increased or priced down, and on average, how much it is. It's very similar to the stat I provided in my last video. So what I've done here is actually accumulated all those numbers and put it into one PDF for everyone to see. So if you want it, check out the link in the description below and grab it for yourself. So as we can see in Vancouver on the map, it's a lot of red. So a lot of the inventory is actually being priced down. On the other hand, for Ontario, there's no such website that does the same thing. People were telling me bungo.ca, however, that website is still suspended by TREP. So the best I could do is look at House Sigma and look at the absorption rate for all the cities in Ontario. So basically what absorption rate is looking at how much sales is happening versus current listing. So if there are 1,000 sales and there's 3,000 listings, then the absorption rate is 33%. So looking at absorption rate, we can tell how fast inventories are being sold in a specific city, and that could tell us if we're in a buyer market, a seller market, or in a neutral market. So here what I have done is actually isolated the absorption rate for house, townhouse, and condos and sorted them across different cities in Ontario, listed their absorption rate, and indicated what kind of market they're in currently. Again, all these data are in the description, so click the link below and grab it for yourself. Now, before I continue, I want to talk about two things. Number one is all these data, all this research, every video takes me a long time to prepare. So if you could please hit the like button below, it helps the YouTube algorithm that these videos are preferred by you guys and can be recommended to more people in the future. Number two is I have a private group on Facebook where I will share extra info and exclusive content on there. So if you want more content or ask questions for yourself, make sure you request to join my group in the description below. Alright, the last thing to look at are different programs either coming to an end or being introduced to the Canadian economy. So the first one is obvious, the mortgage deferral. September is going to be the end of the 6-month mortgage deferral program. According to this article, 2.6 million Canadians have deferred, which is about 9% of credit consumer in Canada. Inside, 28% of the deferrals are for mortgages. As of end of June, 760k deferrals, which is about 16% of all mortgage holders in Canada, have deferred. And this is very important because while it's not the same as 2008, it does have very similar feeling where people were on a timer. So what happened in 2008 was in America, people were paying something called subprime mortgage rate, which is extremely low, but it's more like a promotional rate. Once that promotion is over, the rate is going to jump to a much higher rate, and a lot of people were way over leveraged. A lot of people will have to default on the payments. Here you could say it's better or it's worse than the situation in 2008 because you could argue that people now is not even paying. So before people were paying something, it's just the new rate was too high, they couldn't continue to pay. But now people, it's going to go from zero payment to suddenly back to 1,500, 2,000, 3,000 plus mortgage payment monthly. So I would imagine it's going to be very difficult for some people. And that's why the articles have been saying that mortgage default rate will jump in the last 3 months of 2020. And this brings us to the next program. the CRB. Not CRB, but CRB. This is a new program the government introduced on August 20th. Basically, they're going to pump $37 billion into this program to extend the CRB for 4 more weeks and also for CRB to be in place. Now, this program is basically going to be like a hybrid of CRB and EI. It's aimed to help and provide income while you're still working. So in general, instead of getting $2,000 a month, now you're getting $400 per week for 26 weeks. And then after that, depending on how much income you're getting, it's going to get prorated and lower. Now, I'll probably make a separate video next week just talking about this program. I want to spend some time and learn about this first. And while this can buy us more time for the economy to recover as a whole, it will also create a future issue where it gives people a false sense of security. And as these deferrals and programs phase out, some people might get hit very hard if they're not used to the income suddenly stopping. So I want to summarize and draw some conclusions here. First of all, we can see that the inventory is not moving as fast as people expect it to be. And also, supply is stacking up very fast due to Airbnb units now turning into sales because it's no longer profitable. Now we really have to pay attention whether the demand can keep up with the new listings and whether the pent-up demand is coming to an end. While doing research, I can see that some areas which used to be a seller market is reverting back to a neutral market, and some is going from neutral market to a buyer's market. So if you are checking out houses right now, I definitely recommend you use things like Realtor Check if you're in Vancouver, or House Sigma if you're in Toronto. They have a lot of very good features that let you filter out and isolate properties that have done multiple price change, and you can see if those are a good buy for yourself. Also, if you have websites you think I should look into for real estate information in your area, please leave me a comment below so I can look into it and include that into my future update. Now, when I first made my first update, I said that for a market to really have an impact for this pandemic, it's really going to be about 9 to 12 months. So that was 3 months ago. So for the next 6 months, it's going to be very interesting. We'll have to pay attention to as the mortgage deferral is phasing out and with the new program coming in place, plus economy is recovering, how's the consumer's preference going to be when it comes to renting, and will the mortgage default rate jump significantly? So let's keep an eye on it. I'll continue to provide these updates. If you like these kind of videos, I do upload them every Tuesday, 8:30 EST. So make sure you comment, like, and subscribe to my channel. Click the like button so you get all the videos in the future. Alright, this is Jackie Cole. I hope you found this interesting. I'll see you in the next video. Bye!